Hey everybody, I'm going to introduce you guys to a new concept of mine. Well, it's not new to me. I created this way back. This is actually the stepping stone to how I developed the three-tier system with type 2s and type 1s. This was one of the earliest ideas that helped me to develop this system. It's called consequential order flow. So right there. Consequential order flow. So let's think about the name here. Consequential order flow. Let's break that into two words. We have order flow. We understand order flow is like the taking of liquidity, the filling of imbalance to reaching a desired target, right? We have structure. We got order flow. The way we look at it is really we prioritize order flow and we view that as structure altogether. So disregarding like these higher highs and whatnot, because it's not really important. What's important is tracking order flow in the market. So what is consequential order flow? The first word is consequential or consequent, right? Or is a consequence of something. Like if you do something bad, what are the consequences? If you do something good, what are the consequences, right? What do you get as a result of, like what is the outcome of a cause, basically? In this case, the cause is a draw on liquidity, and the outcome is order flow. So consequential order flow means the order flow that develops and takes control as a result of something else happening. Okay, that's great. You've named something, but what do I do with that information, right? This is important because it helps us to build a framework of what to expect on the way from the cause, the effect to the target, right? So from the doll to the next likely doll, right? The consequence of this is lower time frame order flow that we can track and monitor and trade on the way to here. So how does consequential order flow work? We already understand this. I've just never actually explained this to you, and it's built into the type 1, type 2 system. I had a talk with one of our members today, and he asked me, we didn't run liquidity here. So let's see, where is it? We ran the Asian range high right here. Nope. Wait, this is the Asian range high right here, right? So we're looking at this. We have the Asian range high pushed up. We did not liquidate it, pushed down. And he asked me, well, I was waiting for that liquidation to come, but it never came. And I told him, you don't have to because we're no longer in that range of price. We've moved to a new range of price when we broke the low, right? This SMB, right? This isn't confirmed, sure, but we understand that it is confirmed because our bias is bearish. Therefore, we don't need a body break. We need a body break to confirm it to the upside, okay? Or the opposite side of our bias, okay? So if a wick will do. So we're in this range, pushing down, pushed up, failed to liquidate, then pushed down. And he was waiting for this liquidation to then take sells. Okay. I told him we don't need to. We don't need to wait for that because we're following order flow in steps. Okay. So we need to look back to the origin. The origin was this higher time frame draw on liquidity. Then we have to look at the next likely draw on liquidity where we can see order flow start to shift, which is the NLDOL right down in here. So taking liquidity, targeted liquidity, right? Taking liquidity from here, look back in price. We do not see anywhere that can stop us besides down here. So that's automatically the next likely draw on liquidity. So we have to ask ourselves, what is the consequential order flow, or how will order flow develop on the way there? And how can we follow it until we do? So we understand that type 2 should hold. Type 1 should definitely hold. Type 2s should hold until we get to the next likely draw on liquidity. Okay, that is in essence what consequential order flow is. And what we can do to monitor it even further is we can build the ranges out as they happen. So we have one. Oh, I've actually marked everything out for you guys. but we see type 1, type 1, you've swept, type 2, breakdown, SMB. This is a failed ISP. Failed ISP has failed to push us higher. Therefore, when it breaks down, the failure of the ISP becomes an SMB. Okay, great. We have, from now on, I'm going to be calling failed ISPs SMBs because they operate the same. We have SMB down, pushes back up, or sorry, ISP down. This pushes back up. It takes liquidity out of the market, giving us an SMB, right? Now we are bullish. We do not take out this high though. Pushes down, gives us an SMB back down, re-engaging us bearish, fails to take the high, produces a long-term swing point because we have lower ISPs on each side. And we can expect that we're going to continue down further up until here. And we're definitely not going to come above here because, well, that's a long-term point. What we could do now is start tracking ISP to ISP, okay? So first thing to do this, we need to understand what is a break of structure. A break of structure happens when an ISP pushes down to the point, the lowest point that was created from the previous ISP. And then what we do is we go and we look at the ISP that caused it, the most recent one, which is this. So we expect that this is protected, right? In this case, there's no real tradable zone. We've come into some draw on liquidity. Price decided to push up. It's an Asian range anyways, no trades available. Push in, create a new high. Failed to take out this level here. Does that matter? Not necessarily, because the liquidation has already happened up here. And this is why consequential order flow is so key. The necessity of the market was to hit a doll. And now the next necessity of the market is to take the end all. Whatever happens in here doesn't matter. We don't need excessive liquidations on both sides. We just need to go from point A to point B in the most efficient and effective way possible. And we track that by tracking order flow. So what we do is we measure ISP to ISP like so, and I will throw that on the chart. Here, I'm going to mute the FEGs. Understand FEGs are type 2s, and the sweeps of liquidity or structural sweeps are type 1s. Turn on order flow here. Okay. Now, let's take a step back here. We see boss and we see boss. So a boss is when an ISP takes out the low that was produced by the previous ISP, or in other words, when we exit the range, right? So here we have a range. We have exited the range when we broke out. Then we look at what caused it. So we measure range high to range low because that's the last candle down. We exited that range. So we look at what caused it. This one. Measure. We look at the exit of the range here. We look at what caused it. This one. We measure, exit the range, what caused it. This one. Okay. When we hit the next likely draw on liquidity, we expect type 2s to not hold and type 1s to hold. Okay, so if I turn off the order flow map here, click type 1s, we can see the 2 times that we've hit a draw on liquidity. On a lower time frame, we hit one here. It's one shape or form, we pushed up. Again, we may not be able to catch that in real time, and that's completely fine. This isn't even a tradable area anyways because of time of day. This is Asian session. Create a new type 1. So we can see that this type 1 is holding. We push down, give an SMB back down, and then we have a new type 1. Reacts, reacts. Break down, no type 1s at all. And then we hit the draw on liquidity. And pay attention now to how order flow pushes up and takes out all of the type 2s up directly into the type 1 before reversing. And this is why we say when you hit the draw on liquidity, you can expect type 2s to fail. And we're looking for the type 1 to hold. Okay. Let's go back now to the order flow map and look at this further. We see what are we looking for in each one of these ranges? Every time we produce a new range, meaning the low, the ISP to the lowest point that the ISP has formed, we look up and we look for 2 things. We look for FEGs or areas of liquidity. We see FEG mitigated here. We see an FEG in here, but we've already came down and we've taken out liquidity out of the market. So this one doesn't interest us too much. We look above it, take liquidity, push down, SMB, back down because we had one up, SMB back down, pushes down, lowest point. This is the range we're trading from. We should have no expectation that price should come up above here. We don't need to come up above the Asian range. The necessity of the market, the draw on liquidity, has already occurred, and the order flow is a consequence of it. And we assume always that it will form or develop in the most efficient manner. Again, over here, you have a FEG, tap in, push down, you have an internal structure level, and this is where we differ significantly from other communities. We contract this internal range, still expecting that this will be the break. Why? Because the desire of, or the need of this range is filled. When we fill the imbalance, it is satisfied. Therefore, any new imbalances on the way are valid. This little range now, because we've filled the imbalance, is check satisfied. This range now, because this is the range that pushed in the new low, right? Now we can argue that this is a type 1, and I would say that that's more than likely correct. You can see we tap above it over here, but markets aren't perfect. We tap above it by what? Maybe half a pip. Regardless, not important. We don't need to look at this level to come into until we break this low. We take that low, but then we produce a new range to trade from. We can come above this liquidity, but we don't need to, right? So we're always trying to trade the highest probability, which is that the type 2 will hold, which is from here to here. Type 2 pushes down. We have a type 2 pushes down into next likely draw on liquidity, right? So what we understand here is that type 2s will hold consistently for each new ISP range or institutional range, aka our order flow range, until we hit draw on liquidity. As soon as we do, we no longer follow this rule of consequential order flow. We disregard it, and then we immediately go back through this leg. If our expected bias is bearish, like in this case, we're expecting to put in a new low, then we immediately go back into this consequential order flow and map out the type 1s that were available. Type 1, type 1, and this one, depending on how you look at it, could be seen as a type 1, and we just tap above it, right? Nothing is perfect in trading, but that is close enough to perfect that I would care for. And that's it. Thanks, guys. Let me know if you have any questions, and I'll go more in depth on this topic. Please ask me questions, and I'll make sure to make another video if necessary.